This spreadsheet kind of will walk you through the numbers that are in Chapter 4, so it's another way to learn the material if just reading isn't the best way for you to learn. So all the numbers that are in here relate back to Allied Products, which is the company that we follow a lot for these first chapters. And the numbers are the same numbers that you'll find in the book. And so we'll start with the common size balance sheet, which shows that we have total current assets of 1,000, total assets of 2,000. Of course, all these numbers are in millions, so we're actually talking about a billion and 2 billion. And then going on down to the liabilities and equity section, let's focus on our ratios on the very first one we normally do, which would be the current ratio. So the current ratio would be 1,000, the total current assets, divided by the total current liabilities of 310. Again, this would be in your book on page 99. So if we wanted to find the current ratio, which is down here on line 74, we would put equals, go up to our total current asset line, 1,000, divided by our total current liabilities of 310, and then we would hit a return or an enter, and you would see the 3.23. So you could look through all of these ratios that have been done, and you could find the numbers that they've inputted into these cells from the numbers up above. And then we would also see what the numbers were for 2010 as they were in the book, and also the industry average. So as we analyze these financial statements, we would want to analyze these ratios in 3 ways. One way would be trends. So is the ratio improving over time, which we only have a 2-year time. Second way would be, how do we compare to the industry average? And that's a little tricky because we'd have to analyze whether or not the industry as a whole is doing well. But we'll assume that the industry average is a solid number here. And the third way would be, are we hitting budget targets? So if the management had set a target for the current ratio of 3.2, then we would say we're on target. If the management had set a target of 4, then we're below what we should be. And so as we look at the trend, we would say, well, currently in 2011, we have about $3.20 worth of cash coming in over the next year in our current assets for every $1 worth of current liabilities we're going to have to pay. And if we compare that with the industry average of 420, it would say we either don't have enough current assets or we have too many current liabilities, but we are not where we need to be. And then we could also say that our trend, is not necessarily good. So 3.23 sitting in isolation should mean absolutely nothing to us, but it's when we take it in context and we compare it with the numbers that we have on the industry and in history and for our budgets that we can start to interpret whether or not we're doing well with our company financially or not well. Then down below it shows the Dupont equation. So this is the steps to find the return on equity, which is net income over total common equity. And up above we have calculated it. It's right here, 12.5, which was net income divided by total common equity. But we could also break that apart, and we could say that we take our net income divided by our sales and get our profit margin of 3.9, multiply that times our total asset turnover, which are sales divided by total assets of 1.5, and finally by the equity multiplier, which is our total assets times divided by the equity. So we compare that with our industry average of 15%, and we can tell kind of where our problems are. We don't have quite enough of a profit margin, so we're a little behind where we ought to be in the industry. We maybe are a little over invested in our assets. We ought to be able to turn that over a little bit better, 1.8 compared to 1.5. And then our equity multiplier, or the amount of equity we're using in comparison to debt, is a little higher than the average. So using the Dupont helps us to break down a bigger number and more an important number and take a look at where the problem might be. So sometimes we might look at this and we might actually be beating the industry in the profit, and our equity multiplier may be in line, but maybe our problem is an overinvestment in assets. So it helps us kind of break that apart. And then this shows a little bit more of the trend that we don't have above. And so we can see that the industry has kind of been moving up. It maybe slipped back in 2011 versus Allied has been going kind of in a poor trend for 3 or 4 years here. So, and then there's several other pages on this spreadsheet that you can take a look at. Table 4.1 is going to reference back to the book again, but it's going to show you how different amounts of leverage is going to change your return on equity based on whether or not the business conditions end up being good or kind of average or expected or poor. And then you'll also see the answers to your self-test questions. So if you want to kind of check yourself in the back of the chapter, you know, 4.2, 4.3, 4.5, and then also from the appendix you'll be able to do some checking on numbers that you might want to work out yourself.